Let's take a look at a financial contract known as a warrant. Now, a warrant is a call option, and a call option gives the holder the right, but not the obligation, to buy shares of common stock at a fixed price. The difference here is that when you have a call option, you'll get the shares from someone who already owns the shares or who is going to go out into the marketplace and buy the shares. When you have a warrant, the company is going to provide those shares. So they're going to increase the number of shares they have if the warrant is exercised. Warrants also tend to have longer maturity periods than exchange traded options. So one of the purpose of warrants is that companies may use them to sweeten the pot when they're issuing, for example, bonds. If it's a company that may have to pay a very high interest rate because they are not very creditworthy, they may supplement that by adding some warrants. So you get some upside benefit if the stock goes up, but you have a floor in terms of the amount of money you receive from the bond. Okay, this is somewhat similar to convertible bonds. Okay, but warrants are a separate entity that can also be traded. What factors affect warrant pricing? Just like with a stock option, the higher the stock price, the more valuable the warrant. The lower the exercise price, the more valuable the warrant. The more volatile the stock price is, the more valuable the warrant. Now, normally we don't like volatility, but when it comes to options, whether it's a call option, a put option, or a warrant, we like the chance that the stock will fluctuate a lot and that the security will finish in the money. They are positively related to interest rates. The longer the expiration date, the more valuable the warrant, and dividends will negatively affect the value of the warrant. So, when a call is exercised, the call writer purchases shares in the open market to satisfy the contract, or gives up shares they already own, which is what I mentioned previously. When a warrant is exercised, the firm must issue additional shares, and this can have the effect of diluting existing shareholders. So let's take a look at a dilution case. So here's a call option case. So imagine that Mr. A and Mr. B are shareholders in a firm whose only asset is 100 ounces of gold. When they incorporated, each man contributed 50 ounces of gold, which was then valued at $3,000 per ounce. They printed up 2 stock certificates and named the firm AB Inc. Now let's suppose that Mr. A decides to sell Mr. C a call option issued on Mr. A's share. The call gives Mr. C the option to buy Mr. A's share for $150,000. If this call finishes in the money, Mr. C will exercise and Mr. A will tender his shares. In this case, nothing will change for the firm except the names of the shareholders. So if this is the case, Mr. C will have the shares, Mr. A will have given up his shares. Okay, that's the same as in your call option. What happens in the case of a warrant? Suppose Mr. A and Mr. B meet as the board of directors of AB Inc. The board decides to sell Mr. C a warrant. The warrant gives Mr. C the option to buy 1 share for $150,000. Suppose the warrant finishes in the money. Okay, gold increased to $3,500 per ounce. Mr. C will exercise and the firm will print up 1 new share. So the original balance sheet looked like this: $300,000 in gold. The total assets were $300,000. Debt was 0. Equity was 2 shares, and the total value of that was $300,000. Now, what happens in the case of the warrant. In this case, the gold is now worth $350,000. The cash that comes in is $150,000. So the total assets are now worth $500,000. Now we have equity of 3 shares at $500,000, total liabilities and equity of $500,000. What do we know? Mr. A and Mr. B's claim will fall from $175,000, which would be $350,000 divided by 2, to $160,667.67, which is $500,000 divided by 3. That's the dilution effect. There's an additional share out there. Instead of 2 shares, there are 3 shares. So how do you value a warrant? Well, you can start with the Black-Scholes option pricing model. And here, the value of the call depends on the stock price, okay, the exercise or strike price, K, the time to expiration, T, the risk-free rate. And then D1 and D2, or ND1, is the normal cumulative distribution function up to D1. So it's the area under the normal curve up to D1. If D1 were 0, okay, standard normal, then that would be 0.5, right? The normal distribution is symmetric. Half the values lie above the mean, half the values lie below the mean. If the mean is 0 and D1 is 0, then it's going to be 50%. If it was less than 0, it would be less than 0.5. If it was more than 0, it would be more than 0.5. And the values for D1 and D2 can be computed here. Okay. If we take that, what we do is we found the value of the call and we simply adjust it by multiplying by n, which is the number of original shares, divided by n plus the number of warrants. Okay, so that's the dilution effect. Before we had 2 shares from the previous example, and then we added an additional share. So instead of multiplying by, we multiplied by 2/3. So let's take a look at an example. XYZ company has issued warrants that give the holder the right to purchase 1 share of the company's stock at $50 per share. The warrant's going to expire in 2 years. The current market price of the company's stock is 55. The stock's volatility is 30%. The annual risk-free rate is 5%. XYZ has 10 million shares and it's issued 2 million warrants. So let's go to Excel and we'll work this out. So we have the formula here, and what I did is I put the values in here: 55 for the stock, 55 for the strike price, 5% for the interest rate. 2 years is the expiration date. Remember, T is the annual expiration date. So if it was half it, if an option expired in 6 months, this would be 0.5. Standard deviation is 30%. And then I've worked out these different parts here. In fact, I recommend that if you build a spreadsheet like this, you do it in parts. So I have this part here, ln over sk, right? And you can see it's b2 over b3, or the natural log of b2 over b3. And I did it for each one of these parts separately. The reason I recommend that you do that, it's a lot easier to find a mistake when there's, just a few values in here. If you have one long equation here, and I find students who do that, it's very difficult to find a mistake where you typed in, 0.5 instead of 5, or you typed in, 55 and 50 and you reverse the order. It's a lot easier if you do this in parts. So if you work this out, you get that the value of the call is $14.16. If this is a warrant, we have to do the adjustment here, and we simply take this price and multiply it by this divided by 10 plus 2, and it turns out to be $11.80. So you can see that the warrant price is somewhat lower than the value of the call option. So I hope you found this useful, and thanks for watching.